Hello and welcome everyone to today's webinar on my CPE. My name is Kate Jones and I'm joining you from Houston, Texas. I hope you're safe and healthy and it's my pleasure to be your moderator for today's webinar. Firstly, I want to make sure your audio and video are working properly so you can see the screen and hear the sound. Please let us know in the chat panel. Also do let us know where are you joining from, that is the city, state or any part of the world. Now, before we proceed, I'd like to thank you for choosing my CPE as your continuing education partner. Also, we have started a social initiative. For every credit that you receive on our platform, we donate one meal to an unserved under our One Credit, One Meal program. So thank you again for supporting our wonderful cause. One more important thing, everyone, to obtain the credit certificate, it is required as per the regulations to remain in the session till the end and answer all the polling questions. And an evaluation form shall be sent within 24 hours of completion of this webinar if you have answered all the polls. And as we all know, this is an interactive webinar, so please feel free to put your questions in the Q&A panel, and the presenter would be happy to take them on the go towards the end if the time permits. And lastly, if you get any technical issues, please feel free to reach us in the chat panel or email us at support@my-cp.com. And just for your reference, we'll be also giving you the instructions in the chat panel. So now then, everyone, let's move on to another part of this session. Yes, the presenter for today's webinar, we have Mr. Drew Stevens with us. Drew Stevens is also a CEO of Stephens Performance with over 35 years of professional business experience, working with both Wall Street and Main Street businesses. He provided three instant methods that led to personal transformation, top line growth, and business success. He works with founders and senior leaders of middle market organizations to scale the business and transform it into a wealthy, profitable organization. His strategic planning and revenue expertise lending have lent and assisting organizations in achieving over $11 billion during the 25-year of tenure. So without any further ado, Drew, the floor is all yours now. Thank you so much.
Thank you so much, Kate. Hi, everybody. It's a pleasure to be here. I'm very excited to talk about this particular subject because there is a lot going on in the world today and a lot that I want to tell you about. So let's just jump right in and get started. As Kate mentioned, what I'm here to talk about is stopping the insanity and stopping the fear that's happening with financial market jitters. And we'll talk a little bit about that as we get going. Just a couple of quick logistics to let you know. Number one is that rather than this become more or less a talking head for the entire session, I love interaction. So the more that we can interact together, the better. With the opportunity that we are utilizing Zoom as a technology here, you have an opportunity to utilize the chat window on Zoom at any particular point in time. And if you want to try that right now, just to say hello, let me know where you're listening to this at, that would be wonderful. In addition to that, just to also test the chat room and make sure you're comfortable with some of the questions that I might ask you during today's webinar. Tell me also why you're attending. What is your goal for the time that we have together so that I can then personalize. The other two things that I'm going to provide you with, in addition to an agenda momentarily here, is the fact that at a particular point in time during the session today, I will have a number of polling questions to ask you. That will help with a little bit more interactivity so that you're not just listening to a talking head, you're actually taking part within today's presentation. And last but not least, I will stop and I will pause. I will pause several times during the webinar, and I will also pause towards the end of the webinar to not only wrap things up, but to ensure that I'm addressing any of your questions and any of your thoughts as we go through. All right, so with that in mind, are you ready to get started? My goodness, I hope you are. Let's go. I'm going to get rid of my chat window here and I'll get right into this session, right into this topic, and I'll let you know why we're talking today. First and foremost, as I put this together today, as you can just imagine, the world is in a little bit of a turmoil. We have the effects of COVID-19, the effects of the pandemic. We know here, at least within the United States, we have rising inflation. I'm going to get to that in just a little bit here. We'll talk a little bit more about that specifically. We also have issues related to COVID-19. and the fact that both the supply chain and inflation, along with the impact of individuals returning to work, businesses starting to reopen, are having some impact both in the stock, bond, and commodity markets. There's good news and there's bad news, and I want to address some of that. We also know that at this particular point, that individuals themselves, they are very concerned about what the news is reporting, what the news is not reporting on. And unfortunately, a lot of what you're hearing within the media is affecting the financial markets. And I want to go through some of those things, and I'll tell you a couple of things related to that momentarily. We also have here within the United States a new president. Along with a new president, there were new laws, there were new presidential powers, there were new theologies in which the politics helps to drive the financial markets. And we'll get into a little bit of that. More importantly, we know that more than 50% of adults at this particular point in time have had money in the stock market since 2020. Some have seen some rises, some have seen some falls, and many are asking questions. Many of my clients are asking questions. Why the rises, why the falls? What's going on? Should I be worried? What should happen? I've looked at my statements. My statements are telling me something completely different. I want to know a little bit more. Well, when I put this together, I wanted to answer some questions for you, especially why did I put a webinar like this together? Why did my CPE come to me and say, let's go ahead and talk about something that you feel that's near and dear to the heart? And quite honestly, I looked at this and I said that there were 3, if not 4, vibrant things that are affecting the financial markets on a daily basis. But here's what's interesting. As I started to really put things together, my thoughts down into a presentation, and really started to align with where I wanted you to be for today's area, I actually had more than 4. And there's a list of them here. I'm not going to go through every single one of them, but here is why I wanted to put this together today. Number one, here in the United States, we have inflation that's closing in on 8% or perhaps even higher than 8%. In other words, it is costing you as a consumer 8% more for certain items. I can tell you right now that that is just a broad-based approach. There are certain situations where on commodities, whether it's milk, whether it's eggs, you're paying maybe 12, 15, and in certain instances, maybe close to 20% higher than you did before. I can tell you right now for gasoline, you're paying almost 49% more for a gallon of gasoline than you did this time last year. Part of that is predicated on the Russian war that has just recently developed with the Ukraine and issues related to that. As I deliver this presentation to you, in addition to some of the things that we're talking about, over the last 2 years during the COVID-19 pandemic, in order to sustain the market and in order to help people with consumer purchases and consumer acquisitions, especially because of the number of individuals that were unemployed during the pandemic, the Federal Reserve lowered interest rates. And that affected your banking, that affected your checking, that affected your credit cards. It affected real estate. It affected gasoline. It affected your student loans, and the list goes on. Well, interest rates are rather low. As a matter of fact, interest rates are so low, at least on the federal level, that they're down literally to 0%. That doesn't mean that that is what the banks and the credit cards companies are charging you, but they are relatively low from where they used to be back in the 70s, the 80s, and the 90s. Well, as I deliver this presentation to you, the Fed is set to heighten interest rates. That will affect the financial markets. May not happen while we're speaking. It may not happen until the end of the day. May not happen until tomorrow. But the fact is that it is something that you should be aware of. We also know what's plaguing on the market are supply chain issues, which still continue to abound worldwide, not only just nationally. What also tends to affect financial markets is that there is a host of merger and acquisition activities. AT&T is going ahead and getting rid of its Dish network. Dish is doing certain things with other streaming services. We have seen streaming services go out of business. We've seen the merger of other streaming businesses. We've seen the integration of streaming businesses on items such as Roku and Amazon Fire Stick. What we know to hold true is that there are businesses that are going out of business simply because they cannot afford to stay around, and we have huge merger and acquisition activity. And then finally, we have individuals that are out there today that are relatively just too scared. I have a dear friend of mine for 42 years who had taken a hit back in March 2020. Things have gotten a little bit better, but he is still very skeptical about opening his financial statements. And that's where there is an issue because many people really don't know how the markets are affecting them. And that's the education I want to give you. What I wanted to really do is give you information and provide you education in the financial markets so that you can make better decisions moving forward. Well, who am I to deliver this webinar to you? Where did I get started and how did all of this get to this point today? Well, I received my start on Wall Street many years ago. I was not a trader or a stockbroker. I was selling systems and services to portfolio managers, to research analysts, and mostly to traders and brokers on Wall Street. I stayed around and I learned how to trade the S&P 500. I learned about what foreign exchange rates were and how to trade in the foreign exchange markets, as well as commodity markets. I trained with a very influential individual that taught me things such as fundamental and technical analysis many years ago, back in the 1980s. And it is something that I've just loved ever since. I did get away from Wall Street for a little bit, and that is because I have been a restructuring turnaround expert for a number of years. But Wall Street was still in my blood. I am constantly staying active in Wall Street. I'm doing the research, reading the analytical reports, staying on top of things. And I returned to Wall Street roughly 7 or 8 years ago. And now I'm actively involved as a financial advisor and an insurance professional in that market, helping to create wealth, helping to sustain wealth. And my motto, really helping you stay rich, not get rich, but helping you stay rich. And those are some of the strategies that I want to illustrate to you today. So as we get rolling in today's session, some of the key learning principles that I want you to be able to walk away from is to understand some of the fundamental information about proper trading decisions, what Wall Street is all about, what the financial markets are all about, so that you really can maximize your holdings and you can create better opportunities for growth. I believe that every individual out there, including you that are listening to me at this point, have an opportunity to develop as much liquidity as you want. In other words, when I say liquidity, having as much physical cash as you desire so that you can live a better lifestyle. My hope at the end of this session is that you start to convert a little bit, make some changes so that you have a better lifestyle. And the reason for that is because I would love for you to have a better opportunity for living conditions for yourself, a better opportunity if you desire to leave a legacy to your family or to other individuals, if not your family. So what I want to have you understand is just that trading philosophy so that you, if you're helping clients, if you're a CPA or you're an attorney, or you just want this for yourself. So let's get rolling as quickly as possible. Again, I've got the chat room. I'm going to stop for questions. Please do stop me at any time. I would love to help you into this. Let me give you a very quick history because, I wanted to do this because I wanted to give you some of the foundational elements. If you want me to return and go advanced, then I am happy to go back to my CPE and come up with an advancement of what I'm about to provide for you today. But my hope is to give a baseline because I don't know who's registering for these webinars. And what I want to be able to do is give an opportunity for everyone to learn at the same pace, but be able to use the information and take advantage of it in a number of different ways. When I talk to individuals, I will tell you there were some individuals that are quite astute in the financial markets, but as a whole, I'm one of those that I am a big advocate about bringing financial markets to the secondary school systems. One of the biggest issues here in the Americas is the fact that we just don't know anything about the financial system until we get to college. They will offer courses, at the community level or private institutions in finance, financial management. My concern is that there are 60% of individuals here in the United States that are in some type of debt. We wouldn't be in that debt if we had better education at the foundational level where children today truly understood where the financial markets are. And that's why I want to provide as much of the foundation as I can. So as a broad brush stroke here, I used to do this, and I used to train in the financial markets because I was also training individuals in this particular market. So some of these slides, believe it or not, come from about 30 or if not 40 years of instruction over the years. And partly is because I used to do this while working for organizations that are now part of the Standard & Poor and the Dow Jones family. Trading, financial markets. You can trace the roots of financial markets and trading all the way back to the beginning of time. When man was becoming civilized, they were trading. And if you trace it back to the Israelis, you trace it back to the Egyptians, civilized societies, even the Mayans, the fact is that merchants were buying goods and services and they were trading them away. It wasn't until roughly, the late 1400s in Antwerp, Belgium, that we find that it became the epicenter of international trading, where ships would dock at the port, where merchants would buy goods and services. And believe it or not, bond trading also occurred roughly in the 1400s. As that developed, we had the 1600s, as you know, with the Dutch coming here into what now has become America or the United States. We had settlers coming in and they were trading. They were trading cotton, they were trading pepper, they were trading all kinds of spices in the opportunity so that they could get the monies for bringing those commodities over. It wasn't until the 1700s that we find out that there were a couple of gentlemen that were meeting under a buttonwood tree, believe it or not, at the intersection of what is now Wall and Broad Street, and they were selling stocks and bonds. And eventually that became known as the New York Stock Exchange. That's how the financial markets started, not only around the world, but literally within New York, and how Wall Street itself in Manhattan, New York, became the epicenter. It wasn't then until 1896 where you start to see what is significant today, that when you track the markets, you have an understanding of where the markets are going. And that is because Dow Jones, who is the creator of the Wall Street Journal, also financial news, they were the first financial news reporting system in the world way back before Bloomberg, way back before Thomson Reuters. They were reporting financial news on Wall Street. But in 1896, Dow Jones came up with what was then known as the Dow Jones Industrial Average, based upon, at that time, 12 of the most actively and broad-based stocks within the Americas at that particular point in time. You now know it's the Dow 30, and it's gone from there. So when we talk about financial markets, I want to give you an understanding, because a lot of folks are solely focused on stocks, or some folks are focused on bonds, or every now and again you hear a lot of noise related to gold and silver and platinum and gas. Well, let's start from the very beginning. What are financial instruments? Financial instruments, quite honestly, are nothing more than monetary assets. They're monetary assets that are purchased, they're traded, and they are created for the opportunities to be traded. That's all it is. That's what a financial asset is. And when I'm doing this, I'm doing a broad-based approach. We could say that it's art, we could say that it's stocks, we could say that it's commodities, but there's an array of different things. somebody is, I'm sorry, Ken is asking me to point to the link with the outline. Ken, there's in the chat box, there is a link to the PowerPoint slides that I have here. And in there, you will see an outline of the of what the agenda is for this morning. So I'm hopeful that helps. If you can't find it, Kate is my incredible facilitator for today, and I'm going to have Kate make sure that she sends that to you in the chat window. So just hang with me momentarily here. In addition to some of those, here are some examples of what financial instruments include. They're cash, such as certificates of deposit. They're money markets. They could be stocks, which are public or private company. Yes, you can own shares in a private company. It is certainly possible. There is then something that's known as debt or debentures, depending upon what financial statements you're looking at. Most of the widely known debt that you're familiar with is U.S. Treasury debt, such as bills, notes, and bonds, or even municipal bonds. We have then commodities: coffee, sugar, cocoa, oil, gold, silver, platinum, and copper. And then finally, foreign exchange, which are currencies within other markets. I will be getting into other financial instruments as we go forward. And in addition to that, I want to let you know, if you want me to go a little bit deeper, or if you would like a webinar specifically on these instruments moving forward, let me know in the chat window. I will keep a record of it. Kate will be watching. And what we'll do is we'll make sure that that gets on the agenda. As I said to you, I've got a couple of polling questions, and I've got my first one up, and I'm going to keep Kate busy here. She's going to help me facilitate this very first polling question for you.
All right. Thank you so much, Drew. So the first polling question is up on the screens now. Please make sure to choose the response and to submit the button. All right.
Give you another couple of seconds here to fill it all out. Make sure we have everybody here.
Last 10 seconds. Please make sure to hit the submit button to register your responses. Last 5 seconds and we'll end the poll. All right. Thank you so much, everyone, for submitting your responses. Andrew, it's back to you now. Thank you.
Fantastic. Thank you so much, Kate. So in looking at some of your responses, a couple of folks have been investing for a while. Some people know just a little bit about stocks. Interestingly enough, no one said anything about cryptos. And then somebody wrote, and you know what? I got to thank you for your honesty. I really appreciate you saying, I know nothing about it. And that's why I wanted to put this together for you. As I mentioned before, and from time to time, I'll go back and forth with a couple of different stories and examples for you. But my friend Frank knows nothing about the markets. And when I talk to him, he almost gets panic stricken. And if nothing else, he keeps repeating back what the media says. And so that's why I'm here to help you. I'm here to give you information and educate you so you feel a little bit better on it. But you'll hear from me something that's more important when I get to it. And I don't want to give it away now, but because I want to get everybody on the same page. So why do financial markets become volatile? What creates the volatility? What is it that makes the market volatile? Well, here is a technical way to do that. I want to give you the technical way, and I want to make sure that you understand the real way. The thing about the stock market and where you hear about volatility is when the market rises and falls 1% or more over a sustained period. That sustained period could be 30 days, it could be 6 months, it could be a quarter, it could be a year, it could be literally 12 hours. The reason why I mention that is, let me give you some examples. When President Trump back in 2020 stated that there was a stay-at-home order, The stock market literally that day, and specifically the stock market, took a hit, and the market was way down behind 1,500 points. And at some particular periods during the day, the market shuts off, because after the market in a volatile day goes over that 1%, especially in a decline, the market hits a floor and it will have to shut down trading in order to try to stabilize things. And it will give it another run. Once it goes beyond that dip again, it will then shut off and continually shut off until the market physically closes. So volatility is really based upon that 1% in technical term. Where volatility comes from, realistically, and this is what I want you to know, especially the individuals that put down the absolutely nothing. And even if you decided not to participate and you only know about stocks, or you're only involved in mutual funds for your retirement account, or you just didn't want to say anything at this point because you weren't sure, volatility comes from nothing more than external forces. There's politics, there's economics, there's legal and regulatory issues, there are natural disasters, there is competition, and the list goes on. It's what's known as the external environment. What happens is especially where we are today, with the use of the internet, with the use of social media, anything and everything that becomes, if I may use a word here, a shock, a travesty, could then create volatile markets. As an example, Russia invading their Ukraine could be a volatile market. Heaven forbid it happens again, another 9/11, that would create volatility in the market. A major earthquake anywhere around the world, that could create it. We might have seasonality where snow or tornadoes tend to shut down major arteries, volatile market. Heaven forbid, it has happened from time to time, cybersecurity. What I'm saying is that these outside influences will always seem to create volatile markets. Now, you all know those markets because they're reported in the media. But in addition to that, as news develops and as issues surround the world, a lot of those external events will effectively help the markets. Now, when we look at the markets and you hear about the media reporting, well, there's going to be a correction. It looks like there's going to be a correction, or you're hearing some economist that is trying to drive the market in a certain direction and saying, well, you know, the price of gas and the way that President Putin is going about things right now, and you know, trying to create a little bit of whimsy because this is a heavy topic. The fact is that a market will correct itself if the price of a security declines by more than 10%. And so what you're constantly hearing from the media, and this is where I want to start involving you to what you should listen to and what you should not listen to. The fact is that the media is reporting information that they're getting from economists from some of the largest commercial and investment banks around the world. There are some folks that are out there that, yeah, they could look at the numbers, but they're very pessimistic. And so for quite some time, people have seen the market increase after the effects of the pandemic, and as businesses started to become open, and as we started to go back to what became a life because we were all quarantined and indoors. So as we became vaccinated or decided not to get vaccinated and decided to wear masks, we then were allowed to go out to gymnasiums, if you remember. We were allowed to go back to museums, back to movie theaters, and even, although it was sporadic, we were allowed to go to the grocery stores. We were allowed to go shopping again. And where I'm going at is many people said, well, the market could only sustain so much and then it's going to fall. You know, there's just so many businesses that could be open. There's just so much buying that's going to happen. So everybody is going to fall. What I'm telling you is you've got to be very cautious about the news that you listen to. That is a foreshadowing for some of the other things that I want to let you know about. Let's stick, though, with some of the more imperative points here. And that is, so what do you invest in? What should you invest in? How should you invest? Well, let's do this. There are certain things in the financial markets, and they're known as asset classes. And when I talk about asset classes, it's nothing more than a grouping of financial securities. That's all that is. So I'm trying to give you some understanding of the vocabulary that's used, only because when many individuals, they talk about the financial markets, well, the stock market, this, and what the generalization is when you're thinking about the stock market, you have to be thinking about bonds. You have to be thinking about foreign securities. You have to be thinking about municipal bonds. You should be thinking about real estate and other things. And I'll get to that momentarily here, but because everything is integrated, I don't want to keep anything from you, but you should understand that the financial markets themselves, the integration involves what you're seeing on the slide. If you're not watching the PowerPoint, you're listening to me through audio, here are some of those asset classes. And these are not in any chronological order. It's simply the way that it just came out of my brain. First, there are fixed income securities. These are what's known as debt securities. These are your US treasuries. These are your municipal bonds. That's what's known as fixed income. The reason why they call it fixed income is because, when you get a bond, and my grandmother used to do this many, many years ago, they used to clip the coupons out when I was a child, and I remember going to the bank and redeeming the bonds. That's not normally done anymore. But what'll happen is because of all of the electronic media, the disintermediation, you buy a bond, $10,000 worth of bond. The bond is supposed to yield a specific interest rate at maturity. So let's say 5%. You take 5% times the $10,000. That's how much you're going to make on the bond, because it's a fixed rate over the amount of time that you'll have it, whether it's 10 years, 20 years, or 30 years. That's why they call it fixed income. There's then equities. Equities are made up of small cap, mid cap, and large cap funds. What that means is large capitalization. In other words, the capitalization of what's known as market capitalization is the amount of shares that that organization has sent out to the market so that they can get shares, so they can use that to scale, versus the worth of the company at that particular point in time. And what you do is you just take what that company is making at this particular point in time, you add the shares to that, and that's what's known as market capitalization. So you can get it for, like I said, a small company all the way up to a large company like an Apple or a Google. And it could be private or it could be public. You don't necessarily always have to buy shares of equity in a publicly held firm. It can be done privately. There are ways around that. I'm not going to have time to get into that here. Real estate, ladies and gentlemen, is an asset class. Commercial real estate, land real estate, even property management. You can set up investment trusts in real estate because real estate is something that always appreciates over time. You also have cash and cash equivalents. You're going to have things such as money markets. You're going to have things such as commercial paper. You'll have treasury bills because there's zero coupons in certain situations. They are highly liquid, and you also have certificates of deposit. Art is considered an asset class. Look at the art that's sold. Celebrities get them all the time, from a J-Lo to a Taylor Swift to even Derek Jeter in baseball. The fact is that those are asset classes. Something that's occurred in the last 10 to 12 years is venture capital. Now, don't misunderstand me. Venture capital has been around for quite some time, but over the last 15 to 20 years, more liquidity has been available in the markets today. Individuals have gone ahead and invested in other things, and they've gotten some very good returns. As they've received those returns, they have been thinking about where else can they place their money. So whether it's, and I remember the name before from the chat, whether it's Ken, if he is looking to do his own startup, if Kate, if I can choose her for a moment, if she decides that she wants to run her own firm and she needs money to scale, well, that's where venture capital comes from. I had worked with a venture capital unit at one time many years ago as I worked on Wall Street, and it is a quite lucrative market. And there are a number of venture capital firms that are out there today, way too many to go through, but it is a way for companies to really scale the revenue and grow, and people are always looking to invest in new companies. As I mentioned to you, foreign currencies, foreign exchange. I used to be the chief operating officer for an organization that was teaching people how to trade on foreign currencies. There were 21 active, but there are 250, 300 different currencies around the world, and they're constantly traded. Just think of the fact that if you were to visit Mexico for a vacation, you're going to have to trade your US dollars to Mexican pesos. And that currency is always evolving each and every day because it's worth different things based upon the supply and demand of that particular currency. Speaking currencies, last but not least, crypto. Yes, digital currency has abounded in the last 5-6 years. It's starting to get more acceptance. At one particular point in time, China has decided that they were going to create their own digital currency. They backed off. There's still rumors as to whether or not they're going to actually create their own digital currency. But I know many financial advisors are now recommending cryptocurrencies for investment portfolios, depending upon the risk of the individual that wants to take that in. And I also know if you will look at, say, exchanges such as Coinbase, there are a myriad of cryptocurrencies out there. Everybody knows the major one, which is Bitcoin or even Ethereum, but there's many, many more digital currencies than that. But that'll give you just a quick overview of what's out there. So let's start with the very beginning, how do markets work? It's real simple. It's based upon two very simple formulas. Formula number one, supply and demand. It's that simple. Supply and demand. There's enough supply, there's enough demand, they meet the two, but that supply and demand is then going to be predicated on formula number two. There's got to be a buyer and there's got to be a seller. Anything and everything potentially is for sale. It could be real estate, it could be art, it could be computers, it doesn't matter. As my grandparents used to say, someone else's trash is somebody's treasure. Now, that's not to say that there's trash out there, because public companies that want to go public for scale, they're going to need buyers so that as they sell shares out, they need people to come in and buy those shares so that they can use that money for scale. Commodities, coffee, sugar, cocoa, the list goes on, petroleum, silver. You would take commodities for two very different things. Number one, when it comes to commodities, there's a cash equivalent. So if you're looking to get a return on investment, if you think that coffee beans, which is something that I like as an example, and Ethiopian coffee beans are going to be priced higher tomorrow than they are today, you can invest in the commodity market and hope that you get that 5, 10, 15% return. On the other hand, there is something in the commodities markets known as futures contracts. And what you're betting is that the price is either going to rise or lower somewhere at some point in the future. But what happens with commodities, there are times rather than take cash, you take delivery. So if some of you, and I happen to live in the Midwest, but if some of you, it doesn't matter, East, Midwest, or the West Coast, you see a farm as you're driving along and you'll see signage at the farm. That farm could have soybeans, that farm could have corn sitting on it, and there's a sign there. And what that means is that rather than take cash, somebody is going to give cash to the farmer, because the farmer is then going to deliver bushels of corn or bushels of soybean. That's how all of that gets to the market. And that's very, very quickly how the commodities markets work. Buyer, seller, and futures contracts or cash contracts. So where does the market volatility come from, as we were talking about before, when you have a buyer and a seller? Well, as I said, the volatility itself comes from changes in the prices of the asset over a particular point in time. We know that no matter what, there are these external forces that are always hitting the market. They're always plaguing it. You think of any boxing match where you have two boxers that are going against each other, and you have buyers and you have sellers rather than two individuals. And they're bopping each other, and they're bopping each other because these are some of the things that are affecting the volatility in the market. That, in other words, they're going to stand straight up, and eventually one of them is going to waver and fall over. And that wavering is where the volatility comes from. Some of that volatility comes from the slowdown of COVID-19, or the opposite side of that, where now, as I said before, mask mandates are falling, people have become vaccinated or even boosted for that matter, people are returning, people are starting to buy, but realistically they had been buying because a lot of folks have been buying online. So that had created a little bit of market volatility. We know that supply chains created volatility. You look at issues such as toilet paper, for instance, during the beginnings of COVID-19 and the machinations of that. What, a 4-pack of toilet paper is $1.99 in, say, a Walmart or a Target, as an example. I may be slightly off on the price, but at some particular point in time, it might have been $25 to $30 for the 4-pack. I know that masks, as an example, I don't have one in front of me because I'm not wearing it as I used to, but masks were reasonably anywhere between 50 cents to $1 at one point. Before the pandemic, the only person you ever saw wearing a mask was somebody in an operating room, as an example. And I remember one store charging something ridiculous as $60 for one mask during the height of the pandemic, give or take, April of 2020. We know that the hospitality industry was plagued by massive amounts of volatility, people out of work, resorts not opening, hotels not opening, cruise ships being placed on the shorelines. That created that volatility. Interesting enough, as I'm delivering this presentation to you, I just happen to have gotten an email or a text message literally about the markets, and the Fed is about to announce, and the market, which was up about 500 points earlier today, is now down in the red zone. Why? Because one of the things about the volatility that you have to know is that you are, as we sit here, individual investors. Understand that when you're hearing these numbers of the market's up by 300 and 500 and down by 1,000 and 2,000, these are the large institutions that are making these buy and sell decisions. You know, part of the reason for the volatility today, and I don't want this to sound like it's personal opinion, but this is research backing this up. When you look at the market today, the price of oil had been going up way before the Russian war with the Ukraine. It was trending anywhere between roughly $72 and $80 a barrel. And it was trading that way simply because of the fact more people were returning to what life was prior to 2020. I don't want to use the new normal, nor am I going to use unprecedented. You've heard that time and time again. But the demand for petroleum was higher in 21 and now in 22 than it was at the very start of 2020 and throughout 2020. So the price of oil dropped in 2020 because there was no demand out there. It went from 60 to $50 a barrel to $40 a barrel. And you're hearing me talk about these prices. You want to know what that means to you? It means that when you were paying $2.50, $2.60 back in 2020, back in 2019, excuse me, and when the market took the downturn, when the market became volatile, when we were all quarantined and we were able to go out every little bit at a time, the price of gasoline, depending upon where you were living within the continental and the United States, was anywhere from $1.29 a barrel, a gallon, excuse me, to no more than $1.59 to $1.65 a gallon of gasoline. That's relatively cheap. That goes back to the 80s and 90s as a good example, the prices that were not seen for quite some time. As more people started to return to what their lives were in 2019, excuse me, the demand increased. So we went from $40 to $50, $50 to $60, $60 to $70. I'm telling you this because in November of 2021, there was an analyst that was saying that the price of gasoline can go to $120 to $140 a barrel. What that means to you is what you're seeing at the pump today. Anywhere from, say, relatively speaking, in the central Midwest of $3.99 a barrel, all the way to the East Coast at $4.50, $4.79 a gallon, all the way to California to about $6.50 a gallon. I'm bringing this up because some of the volatility is based upon some of the ways that the analysts want to see the price of certain products. So if they want bonds to be rated a certain way, they will put news out there and send their research that way. If they want the price of oil to go a certain way. So this is way before Mr. Putin decided that he was going to start bombing the Ukraine. The traders and the analysts were truly having that desire that they were going to push the price up. So know that volatility, yes, is placed on these outside influences, but it's also based upon what the large commercial and investment banks want to do to the market. So with that in mind, I'm right on the mark here. So what I want to do very quickly is just step away and ask my second polling question for you today.
All right, so the second polling question is up on the screens now. Please make sure to hit the submit button to register your responses. We'll wait for a couple of seconds before we end the poll. Last 5 seconds and we'll end the poll. All right.
You guys are doing great.
Thank you so much, everyone, for submitting your responses. Angie, it's back to you now. Thank you.
I hope you guys are enjoying this. Thank you so much, Kate. You're doing a great job for me here. If there's anything I've not responded to yet, please let me know. I want to be able to do whatever I can to help you out. Now, thank you for your transparency when it comes to, you know, is the market volatility affecting you? Is it getting you nervous? You know, I will tell you there should be a little bit of nervousness to it, but let me allay some of your fears, okay? Couple of things that I learned early in life, especially when I was working on Wall Street. The first I learned from a trader at Wall Street who was trading government bonds at Merrill Lynch. His name is John Spinella. Haven't spoken with him in years, but John was a very, very big mentor when it came to understanding the financial markets. I was all at 20, came out of Rutgers, didn't really understand the markets that well. And he said, let me give you the best piece of advice ever. And I said, sure, John. And it's stuck with me ever since, ladies and gentlemen. And it stuck with me for 40 some odd years because I just turned 60. And that's this: trade with your head, not your heart. Trade with your head, not your heart. And I'll get to that momentarily. But that is rule number one and why it shouldn't make you that concerned. Number two, though, you need to do your own research. And I want you to write that down. And if you don't have something to write with, please text it on your phone, put it down to memory, because this is really important, ladies and gentlemen. You need to do your own research. Remember what I just said about the analyst trying to drive up the price of oil? Well, here are two examples of why you cannot trust some of the things that you're hearing in the media and why you can't trust a lot of the analysts that work for these large institutions. Number one, there's a gentleman by the name of Jim Cramer who for ages has had a show on CNBC or MSNBC. I probably have the channel wrong, but I want you to know that he has a show called Mad Money. And he gets on and he's got all these squeaky toys and he's yelling and he's screaming. And he's talking about this stock and that stock and what to invest in, what not to invest in. He specifically said in March 2008, as the market was taking a downturn, hey, don't worry about it, ladies and gentlemen. Hey, don't worry about it. Bear Stearns, they're not going to be in trouble. They're going to be around forever. Guess what? 2 weeks later, Bear Stearns was out of business. He used to be a trader at Goldman Sachs. All he was doing was helping his own portfolio. And so he gave you wrong advice. I knew that Bear Stearns was going to fail. No firm is too big to fail. My client was Lehman Brothers. I used to service Dick Fold, who is the chairman and CEO of Lehman Brothers. And when you have 6 CFOs in the span of 2 years, and you just keep seeing the company not making money, I knew that that company was going to be going bankrupt or merged or something. Did I think that the Fed was going to shut them down? No, but I can tell you this because of the knowledge that I had about Dick Fold, and that was the fact that he didn't make a lot of friends on Wall Street. And when you don't make friends on Wall Street, which is its own huge fraternity in and of itself, well, guess what? At some particular point in time, this was payback because he certainly got somebody angry. So I need you to understand, you got to do your own research. You can't listen to a bonehead like that. And here's what's worse. Alan Greenspan, who was the chairman of the Federal Reserve back in 2008, after everything was all said and done and Alan retired and made millions of dollars, not only from what he had on Wall Street, but from being the Fed chairman and the money he made on Wall Street and how he was the top person to the presidents like Reagan and Bush and so on, wrote a book called Alan's Greenspan. I read the book and I was mortified what I read in the book, because this is a line from the book. He admitted to a congressional committee that he was partially wrong in his hands-off approach towards the banking industry. He was wrong. You were the one that was responsible for making all of these decisions that led to the Great Recession. And all you have to say is, well, I was wrong. Seriously? That's what you have to say. Thousands are out of work. Over 10,000 people at Lehman Brothers lost their jobs. The market came to a halt, and all you do is have this conciliatory, Now, I don't expect any money to come out of his paycheck to pay that back, but this is why you need to do your own research, and you can't listen to everything that you hear in the media and on Wall Street. So what do you listen to? What's really going to help you out? 3 things to get you started. Number 1, you got to start reading the news. I am mortified because I do some adjunct instruction and I teach business strategy and management to graduate students, both online and on ground. And I am mortified when somebody who wants a managerial degree on an MBA level comes to me and says, I haven't read the Wall Street Journal. I have no idea what's in it. If you don't have your pulse on the book, then you can't make proper decisions for an organization. If you're going to be investing on the market, then you should at least understand what's happening in the market. The clients that I work with as a financial advisor, one of the first things I say to them, I have a presentation like this. I educate them on the markets because they need to be in the know. I want them to call me, as Mark does, and says, hey, listen, Drew, the markets are volatile. I know I'm making a 6% return. I know only 30% is wrapped up right now in bonds. Is that going to affect my portfolio? Those are the kinds of conversations I want to have. I want somebody that's astute, because you're using an advisor to help me make those decisions. You're not wanting the advisor to make all your decisions. These are what's known as discretionary and non-discretionary accounts. You should have the discretion of what's invested and not invested. While you're reading the Wall Street Journal, take a look at Bloomberg, Thomson Reuters, Yahoo Finance, MarketWatch. All these apps are available on phones and all other types of devices today. Understand what's happening in the market right now. Also, if you're investing, one of you had mentioned to me here that you weren't sure about the markets. Well, I want to let you know, look at quarterly reports, look at annual reports, even understand what that Federal Reserve rate might do to the markets today. And finally, also understand GDP, gross domestic product, which is nothing more than the amount of production of goods and services in a particular country. When GDP are reported, just like unemployment is reported, you will be able to understand what is happening in the markets. Because part of what that news will tell you is how much risk is in the market at any one time. There's what's called systematic and unsystematic risk. When we look at unsystematic risk, what we're talking about there is where the market itself and where the market is volatile. We're looking at reinvestment risk, which is the risk that the market interest rates may increase or decrease over a period of time. We're looking at purchasing power risk, like inflation. As inflation grows, you are technically going to buy less. And then there's exchange rate risk, which is just simply a factor of investing in different markets. The unsystematic side, or the non-systematic side, then includes things like business and financial risk, even credit risk. Right now, believe it or not, as I speak, Russia, and you know what, this may not affect you, but somehow Russia is tied into other countries, other markets, other industries. They may default because, given the fact that Russia is not getting anything and has been sanctioned, their credit ratings, in other words, their ability to borrow, and their ability to pay back on debt is going to be very difficult. And because it's difficult, there's going to be risk in those markets. That too affects the volatility. And that's what I want you to understand, and how that's going to help you out. So what I'm suggesting to you here, a couple of things. Number one, you understand how inflation and why an 8% inflation rate is going to affect the markets. Things are a little wonky right now, to be quite honest with you, simply because of the fact of most markets, and as I followed this over my 40-year history, you know, when you look at this, it's wonky because we've never really had a pandemic. The biggest pandemic we had, it was when my grandparents were around, 1918. Since then, we have had things like SARS, we've had HIV, we've had MERS, but nowhere as devastating as COVID-19 has been. So for that matter, the markets have kind of waddled a little bit. And now what you're starting to see is kind of a topping off, because we have inflation and it's got to stop. There's runaway prices. And I will tell you, part of the inflation right now is nothing more than businesses really taking advantage of you and I as consumers. Number two, you really need to understand their interest rates and what this Federal Reserve increase of a quarter point or a half a point, how that will affect inflation and tend to slow things down. Because remember, if you're going to borrow and interest rates rise, that's going to cost you in your pocketbook. It's going to cost you in credit cards. It's going to cost you in mortgage rates. It's going to increase as far as other things. Now, it might slow things down, but you've got to be understanding of how that inflation will affect you at some particular point. And the other thing, which is what we have right now, is relatively low unemployment. But as things slow down, it's a conversation for another time. I need you to understand that as employment or unemployment increases, and unemployment's going to increase, because I'm telling you right now, as soon as interest rates go up, companies are going to make less money because you're going to spend less money. You spend less money, you're going to see here these Fortune 500 companies, CEOs go, we're not making so much money, and because we're not making so much money, we're going to have to terminate people. Folks, it happens. And so, as unfortunate as it is, you need to have that understanding of how those unemployment rates will roil the markets. I am going to ask you one last polling question, and I'll ask Kate to come right back in and help me with this. I see that something had come up in the chat window, so I will look at that while I'm taking a look, having Kate help me facilitate this last question.
All right, do. Let me just see. Okay, thank you so much. And the third polling question is up on the screens now. Please choose a response and hit the submit button to register your responses. All right, folks, this was really quick. Okay. Thank you so much, everyone, for submitting your responses. Andrew, it's back to you now. Thank you.
Sounds good. Thank you so much, Kate. Okay. So when we look at other stocks and anything else that you want to invest in, I want to give you a couple of things to think about before we conclude our time. Number one, I want you to be calm about the markets. I want you to look at your investments and really have a good understanding of what you're listening to at this point. Like I said, don't listen to all of the commercial and investment banks. What I need you to really do is I need you to really start looking at two things. Number one, conducting your own research. And number two, if there's volatility within your existing portfolio, maybe you want to start looking at other investments. You might want to look at real estate as an example. Home values in the United States, they've increased 50% since 2016. More people are going into real estate right now. Rental income is going up like there's no tomorrow. And trust me, again, it's a conversation for another time, but there may be some short sales because pricing on real estate had gone way, way too high. In addition to that, you could look at insurance. Life insurance, believe it or not, permanent life insurance is just as much an investment as anything else is. You get cash value in a permanent life insurance policy and cash that will grow for you tax free. You can borrow against it. Yes, it goes against the death benefit. And so it's one of those things that I recommend to every single client I talk to. Believe it or not, it's used in executive compensation and something that you should be looking at for yourself. Last thing, you should be taking a look at your pension and retirement accounts. You should be looking where the asset allocations are, and you should be looking at three things. Number one, make sure that the pension is well funded. Number two, look at the interest rate that you're making on those investments. And number three, understand what it's developed with. Is it stocks? Is it bonds? Is it a mixture? The more you understand about those investments, the less worry you're going to have. As I take my leave with you, I want you to understand three things. Number one, I mentioned it before, but it's really important. You have got to conduct your own research. If you're not going to do that, then I do suggest that what you do is start taking and making use of a financial advisor. What I do is I offer free portfolio analysis to anyone I talk to. We do a free asset allocation. And if not, no matter what, you can always give me a call and we can always have a conversation. If you're worried about the markets, I love talking about this stuff all day long. There is no fee at all. We can have a conversation. We can go through the education and we could take a look at what are some of those vehicles that you might want to invest in. But as I leave you here today, I want to let you know one thing. Don't be worried about the markets because things will stabilize. The biggest piece of information I can give you is look at the markets as a long-term investment opportunity, not a short-term. And I've not said that because I was waiting until now to do that. Look at the markets as long-term, not short-term. You do that, you will be well taken care of in years forward. You will have that lifestyle. You will have that liquidity. And should you need it, you can create that legacy. Thank you so very much for listening. God bless you all. Please stay in touch. Let me know what questions you have. My CPA, I cannot thank enough. And ladies and gentlemen, a big round of applause to Kate for helping me facilitate today's session. Take care now.
Thank you so much, Drew. And thank you so much once again for one of the most informative sessions. And we are always glad to have you on our platform. Lastly, for all the users, an evaluation form shall be sent within 24 hours to only those attendees who have answered all the polling questions, and it is required for you to complete the evaluation form in order to receive the credit certificate. We would request you to rate the webinar and provide us the feedback about the platform, speaker, content, and the webinar in the evaluation form as well as in the chat panel. Lastly, if you need to view the recording of the webinar, if you have any further questions, please reach out to us at support@my-cp.com and we would provide you the link to the recording and will assist you further. Thank you so much for being such a wonderful audience. Keep coming back. Stay healthy, stay safe. Thank you so much, Drew.